We're going to take a look at a coin here, and we drew a Fibonacci all the way. Let's see where our first fib. Our first fib was the high here on, what day is that? The 5th
December
of
5th.
December?
Yeah.
To the low at 240. And then we drew a bigger fib that had the very highs to the low just before the earnings event. And wouldn't you know it, we came right into that 250 area yesterday, bounced, and now we are sort of giving a little bit of that back. But 250 is one of those big fat round numbers. And so we could trade on both sides of this if you want to. And so let's have a look. Let's anticipate that we either could go to the gap at 220 or come back to the 275 zone. So we're looking at about a $25 range from where we are right now. And so let's give that a look. First off, I do want to say that we've got a couple of iron condors that are doing pretty well here, and we are going to stand pat with those. What we can do is look into March and say, all right, let's see what why is my mouse being so unreasonable today? Probably operator error. I'm not going to lie.
Lack of cheese, perhaps. Oh, that mouse.
Yes.
I got to make the dad joke when I can.
All right. So let's buy the 220s. A lot of volume there. And we're going to sell the 200s, and we're going to sell 2 of those. It's expensive. And then we're going to go to 180. So that's a $2,000 range on the formation into that edge into March. It's going for about $1.60. So you might be saying to yourself, well, that's pretty expensive. However, what I've noticed on the trade action is these higher priced butterflies are actually doing better than the cheaper butterflies. I don't know why at this juncture, but that is what I'm seeing. So let's say we go 270 to 290. And then to 310, both running at about $1.60 to $1.70. So for $300, you have a potential upside range of a $2,000 max profit, and it feels like it's really in line with what our charts are saying in terms of, hey, if we move into these edges, they're going to have some range. Now, let's think about this. What if it takes a couple of months to actually do that, as opposed to just a few weeks? And we push it into April, you can see how much premium is sitting in these areas. They're much more expensive on the put side, about the same price on the call side. So my thought is, why don't we stagger that? Why don't we do the March for the potential downside fade, because there's a ton of volatility in March, and then let's choose the upside for April. And so that gives us about $300 risk-wise and $2,000 upside. So here's the very interesting thing about a trade like this. If the market is in some sort of correction space that we anticipate that we might be in, the put side could easily double very quickly if we move into our support zones. And our call side, way out in April, isn't going to lose quite as much value.
Okay.
This makes another space of, hey, maybe we're in a really wide range and it ends up looking like this. So that's my thought about what to do with coin. Again, not very cheap, but these certainly are regions that the price action says, hey, we're coming in there. And if it turns around very nicely, you can, if it comes down into that 220, hangs around near the 200, we can close the entire butterfly,
Mhm.
or as it bounces, we can take that 220 for profit if it moves into that 220 area, which would be about, $30 off where we are. You can see that that option will likely be worth about $10. And you can take the profit there, buy another 180. So what you're sitting is in a short bull put spread while you let your call work out. If it gets to be the
Okay.
space where the chart continues to fall, you can simply get out of the call butterfly in April for, maybe a 10 to 20% haircut.